Welcome to my channel. It is April 14th. It's the evening of the 14th. It's 7:30 p.m. Eastern. The stock market has closed. It closed in the positive. So that was good to start the week on a positive note. We had some news over the weekend where the president removed some big categories from that tariff list in China. So that really relieved, I think, Apple and all electronics and computer makers and so forth, because that was a big category of products that were going to be hit with a massive tariff. So that did kind of provide a little bit of a tailwind. The other thing that happened today is interest rates went down. That's a very good sign. Last week we had a big problem, right? I guess it was last week or the week before included. We had interest rates going up while stocks were going down. That usually doesn't happen. But there was a lack of confidence in the US economy by other governments, and they began to sell off bonds that created a higher interest rate environment, even though stocks were going down. That got pretty scary because, we could very quickly, we went up 50 basis points on interest rates, but we could have continued to go up and found ourselves with like 10% interest on mortgages, as an example. I think heads would explode in that kind of situation where people that are trying to buy houses it would just be absolutely unaffordable. We'd have a big housing correction, and we'd probably see fewer automobile sales. All kinds of bad stuff would happen if interest rates really started to take off. So I think the U.S. government realized that, hey, if they're going to break a couple of key pieces to the economy, it's really going to cause a lot of pain and a huge recession, a super recession. So they stopped the tariff fight, and hopefully they keep it, tempered. They can negotiate a little more diplomatically and not really be hostile towards other countries, because I think that really backfired. So we'll see. The stock market is liking the fact that, hey, we're not going to be in a giant fight with other countries over tariffs, at least for this week, it seems. Hopefully it stays that way. The NASDAQ was up, the S&P was up, the Dow was up, and small caps really did well today. We are still in a corrected market. We'll see if the NASDAQ and other indexes, if this is a short-term rally, that'll be followed with additional losses. I wouldn't be surprised if that happens. Stock prices have been high, and we have enjoyed a really nicely appreciating market. If you look at the 2 years before 2025, boy, it was great. We had 2 fabulous years. So giving up some of those gains is a little natural. Like, okay, we got to give up some of those gains. It's not going to go up forever. And we'll see. We'll see if we're going to go down lower, maybe go down another 5-10%, maybe 15. We will see. As a long-term investor, and this channel predominantly is for long-term investors, value-based investors, I would say value with an eye for growth, an eye for quality companies, looking for companies that are discounted, that are quality companies that an investor can own for a long time and really see capital grow over the long time. The goal of this channel is to grow wealth, to start with a pile of capital and make it bigger. Goal is to double that capital at least once over the next 5 years. So it's a gradual way of increasing wealth, and that's what the goal is of the channel. Ways of getting there is finding stocks that are trading below the intrinsic value of that stock, of that company. What is the intrinsic value? It's the cash flows we expect from a company. We discount those cash flows using a discount rate, and then measure what is the value of that stock based on those cash flows. And we'll do some of that on some stocks and analyze those stocks and do a deep dive into them. If you would like to learn more about value investing, about doing intrinsic value calculations and looking at stocks, consider being a member of this channel. There's 3 levels of membership. We've got $10 a month, $25, and then $100. Each level gives you different perks that you can enjoy throughout the month to help you be a better investor. It's easy to do. You go to the channel page, you go on this button here, it says join, and you're off to the races. You can sign up for the $10, $25, or $100 plan. And you get access to the tools I'm going to use today. As I analyze stocks and do deep dives, you have access to the valuation model. You also have access to the valuations that I've performed. And I just kind of keep a sheet with all these valuations. Go straight to it. You'll have access to it. Let's say you wanted to look for Google. You just do a Control F for Google, for Alphabet, and you find it. You say, okay, last time I looked at it was on March 23rd, and this is the valuation I had for that stock. So those are some of the perks you get as a member. And it looks like Brandon is on. How you doing, Brandon? Good to see you. Thanks for being a member. I appreciate it. And on the live stream, I've got some stocks that I want to look at. And at any time, members, if you've got a stock you want to look at, just put it in the chat and I will review it and do a deep dive on it. If you're not a member, don't want to be a member, but you'd like to see a stock be analyzed, a $5 super chat, I'll analyze your stock. Or if you want to be a volume purchaser, you can pay $10 on a super chat and I'll analyze 3 stock tickers for you. So let's get started. I'm going to look at the market real quick. Then again, I've got a list of these stocks, but if anybody has a stock they want me to look at, please put it in there and I will take a look. All right. So the market, what's interesting is a lot of stocks were, in the deep green. Apple was deep green, Eli Lilly, but a couple were deep in the red. United Healthcare, Amazon, Meta, Broadcom. So it's interesting that some days, some stocks just, get taken down. And that's interesting. I'm not quite sure why Meta is being sold off, but it was. And Amazon, I kind of understand Amazon. I think they were a little expensive. They've been spending a little too much capital in that data center. And then Broadcom has been a stock that I believe is overpriced. So I'm not going to argue too much with that one. Looks like Herdo's there. How you doing, Herdo? I had a really good day and my stocks were up. And, something that I did today, if you attended or I recorded the member only call we had yesterday. It was a real good one. We went about an hour and 30 minutes. And, I shared that I wanted to build up some cash because, it's just been a rough market. So I did so. And probably before the market opened, I put some sell orders on like 6 different stocks and I bumped up the price so I would really sell if the price really increased. They all sold. And I sold some Bitcoin. I sold some Ethereum. Again, building up cash, not a big number of shares, but all of them sold. And then midday, especially Meta. Meta is my biggest position. I own a lot of Meta. And I probably sold a couple shares and I sold them when Meta was up about 2%. It ended the day at negative 2%. So it was the right move to do early in the day. And then I had that cash. I bought a few stocks today and I'll be sharing what I buy or sell to members. And I'll be recording a member only video each week and sharing it to members. And you'll know what I bought or sold throughout the week. So look for that video. So it was interesting how the market did trade, but I'm glad that it was in the green. It's supposed to, it's kind of early. It's too early to tell what tomorrow's going to look like. The futures, I'm not going to believe that number just yet. Usually, there we go. So they were in the red a little earlier. Yep. I'm not going to believe those numbers until probably tomorrow around 6 a.m. And then I'll know where the market's going to open. A couple of things. The big cap stocks, was kind of a mixed bag. And Apple was up, but it's down 19% year to date. NVIDIA was down. Microsoft was down a little bit. Google was up a bit. That's good. That's good. Google's kind of been losing a lot of value this year. Berkshire was up again. Berkshire's having a good year. Tesla was up a tiny bit. Broadcom was down a lot. So the big caps are not saving some investors that were just depending on those. So, yeah, thanks, Brandon. I appreciate that comment, and I appreciate your support. Thanks so much for being a member. I appreciate it. And make sure you get me your email address somehow. My email is somewhat easy to find on the channel, and I'll make sure to get you on the invites to the member only calls, get you access to that folder, and just include you on all the stuff that I like to provide for members. So thanks again. And thanks, Herdo, for your support as well. All right. So earnings. Earnings are the big story this week. That's what's going to move the market. Today was kind of a quiet day, right? We had a couple earnings, probably the biggest one being Goldman Sachs. And they had a good earnings, by the way. They did well. But everybody's kind of concerned about the economy now. I think we shocked the economy with tariffs. We were already kind of limping along a little bit. And then that kind of shock caused a lot of businesses to stop spending, and consumers as well. The travel industry is really going down fast. And that's a true measure of discretionary spend. So those things, I think are items to keep an eye on as it relates to the economy. Now, tomorrow we have big earnings. We've got J&J, which is a substantial cap. It's a healthcare business before the market opens. So they're going to announce. And they're not a big grower. They tend to just be really reliable, very trustworthy. So we'll see what they announce. Bank of America, we had big bank earnings on Friday. Another big bank coming out and announcing tomorrow, along with Citi, which is another big bank. I'll be looking at Citi closely. It's one of the stocks that I own. PNC Bank, they'll be announcing. Ericsson, back in the day, this was a mobile phone, big mobile phone player. They're still a player, but they're just not as big of a market cap anymore. United Airlines, that's after the market closes. Interactive Brokers, JB Hunt, we'll see how logistics company is doing out there. That's a good measure of the economy. So that looks interesting. Albertsons and a couple of others. So tomorrow it's going to be fairly active in the early morning hours. We have a member only call in the morning. I'll be sure to cover some of these stocks in the morning and probably record a video or two as well. On Wednesday, we have ASML. That's huge for semiconductor. ASML tends to be the company that talks about how much volumes, how much activity is happening in the semiconductor space. And that'll be a tell on how well NVIDIA is expected to do, as well as the other semiconductor companies. Abbott Labs, another healthcare company, big one. Progressive, they've done really well in the insurance space. We'll see how they report. Prologis is a logistics company, another bellwether of the economy, because logistics companies tell us how much commerce is happening between businesses. So Prologis will be out there. US Bancorp, another bank. Kinder Morgan in the energy space. The Travelers, an insurance company. A railroad company in CSX. Wipro, which is an Indian-based, mostly professional services company. So just a lot of stuff coming at us. And on Wednesday, I plan to live stream in the morning. So I'll try to catch especially ASML. I'll look at ASML, look at Abbott and Progressive, and as many stocks as we can in the morning. Doesn't stop there. On Thursday, we gotta pace ourselves, right? Eat right, hit the gym, sleep right, because you're gonna need your energy this week. And you're going to need it for the next 6 weeks because it's earnings season. We're just getting started. This is like the bottom of the first inning, and it's a 9-inning game. So TSM is going to announce on Thursday, and obviously that's a big one. And based on their volumes, it tells you they basically produce for the semiconductor companies like NVIDIA, Broadcom, AMD, and others. So if they come out and say we're growing our revenues big time, that means the semiconductor space is doing great. If they're contracting at all, that's really bad news. So that earnings is really important and will be watched by many. United Healthcare, I'm expecting they're going to do okay. And Netflix is on Thursday after the market closes. American Express, Charles Schwab, Marsh and McLennan, that's kind of an eclectic financial services company. They do a variety of things. They do risk management and stuff. Always found kind of hard to understand what their business is all about. Infosys does professional services in the mostly technology space and outsourcing space. Truist financial services, a home builder in DR Horton, another financial services in State Street. So we got lots of earnings. And I mean, I'm not even touching the smaller caps, but we have Ali coming out on Thursday. That'll be interesting. So we're going to have our hands full this week. And then Friday will be kind of an easy day. Just one company is announcing on Friday before the market opens. So yeah, it's going to be really active starting tomorrow. Tomorrow is going to be nice and active, and we'll have plenty to analyze. And I think it's going to move the markets. I think healthcare is a good space this year. I've said that many times. Financials, I'm not sure. If the economy slows down, I think financials can struggle. The travel space is going to struggle. That's my expectation, just based on what I'm seeing and hearing and reading. So, Mike, the dividend investor guy, how are you? Yeah, go AMD. We'll see. And I don't know when AMD announces, but I don't see him listed. Good to see you, Michael Anthony. All right. And just a reminder, it looks like multiple members are on. If you guys want me to look at a stock, just list it on the chat and I will analyze it. We'll do a deep dive into it. All right. So I wanted to go through a list that I had in mind. Again, if you guys want to see a stock, I will put that in at the top of the list. But for now, I'm going to look at Instacart. So AMD, we'll look at AMD since Mike is bringing it up. We'll look at that right after this one. And that is on May 6th. Yeah, it's in about 3-4 weeks. And Michael Anthony, if you want me to analyze the stock, just buy a super chat or become a member, and then I can analyze your stocks. Okay, so Instacart, their company name is Maple Bear. Kind of threw me off when I started analyzing the company. And I think the founder's from Canada, and he moved to California, and he kind of combined the fact that he came from Canada, where they have maple leaves, maple syrup. You have the Toronto Maple Leaf hockey team. And he came to California, where on our flag we have, the grizzly bear. And so he named the company Maple Bear. But the website's called Instacart. That's what my wife and I know the company has. We've been a customer for a while. Now, I like this space. I'm a stockholder. I like the space. And I just wanted to kind of revisit this and just make sure that there isn't any good new information that kind of changes the story on them. I haven't heard anything, but I wanted to look at it. So they're going to be reporting on May 1st. So we're 2.5 weeks from that happening. It's an $11 billion market cap. So not a big giant market cap like Amazon. Revenue is $3.38 billion and forward P is 25. That is a little bit high for a small cap, especially since they're growing at 11%. And as we see this market that's sold off, right, that's corrected, I'm beginning to change my I think qualifications of a stock, if we looked at the stock market 4 months ago, it was so expensive. It was hard to find a quality company mid 20s. It was like, geez, you have to pay 30, 35, 40 because stocks are so expensive. But now that stocks are sold off, you can find a pretty good number of good quality stocks in the teens, 15, 18. So once I get into the 20s, my qualifications are getting a little more strict. Like, hey, hold on a second. Let me make sure I'm buying something that I'm really liking because I'm paying a little bit of a premium if I look at that PE, 25 for a small cap. This is an 11% grower on $3.378 billion of revenue. Now, that's a pretty good sized company, but it's not an overly high number on the growth. Okay. So it'd be nice to see Instacart grow. It's a good quality business, but I need to see them grow faster. They're kind of contracting a little bit. Maybe they can, I know they're trying to deliver. Right now they focus on the grocery store and they're trying to diversify into delivering for other types of retail, like, maybe the hardware store or other types of businesses. That's a good idea. They got to find places to grow because if they can grow, their valuation will continue to go up. If they don't grow, they're going to struggle. Now, the one thing I love about them is you see the growth in free cash flow. I value companies based on free cash flow, and this one here produces excellent free cash flow. So that's one thing that they do really well with. And I see the stocks coming in. We will look at TX and Pfizer. All right, so the free cash flow looks really good, and that's the basis of my valuation of Instacart. Is they're producing $623 million of free cash, and they're growing it really nicely. You see how the data sets itself up. It's pretty much, even counting the negative years, they went from negative to positive, and you can kind of draw a line in here. If you've done like regression analysis and statistics in college, you grow regression, you put a bunch of data points literally on a space, and then you draw a line that would intersect the closest point through that data. And here you can draw a line somewhat through all those bar graphs. And I think they're going to continue to grow. Probably this year, they're going to do $750 million for free cash flow. So that's really good growth on the free cash flow. They have good free cash flow margin and good margins overall. It's 75% margins. So the growth, that's what we need to see out of Instacart. If they can grow, that'd be fabulous. And these guys they may be small enough to acquire or merge, especially with like an Uber or, maybe an Airbnb, somebody that wants this business and needs to get larger. This would be a smart acquisition. They're small enough to acquire. When I look at Instacart and I look at evaluation, that free cash, that's where the value is on Maple Bear. The intrinsic value of the company is $18 billion because the cash flow is just really good. And I'm growing it conservatively by 10%. They've grown much faster than that, but just being conservative, being careful, I'm just growing it gradually. And when I compare the intrinsic value of the company versus their market cap, it has a 47% discount. So that's a really strong discount on a quality business. So I own Maple Bear, not buying shares right now. I'm going to hold my shares and look forward to the earnings that are going to be announced in 2.5 weeks and see where we're at that point. One thing that I would encourage you to think about, I like investing in certain industries that I find a couple of things about it is first, I can really understand them. I understand them. I understand their business and I can really analyze them and can decide whether that's a good company, that's a bad company. They're doing well, they're doing poorly. They're operating well or the latter. They're operating poorly. And some industries that I believe in, like the uh, home delivery, I owned DoorDash for a period of time. I did really well with DoorDash. I own Uber. I've done really well with Uber. Uber does both ride sharing as well as delivery. And Instacart, I felt was at a really nice price and it offered me a nice risk reward situation. So I try to pick certain industries that I get good at and I can really analyze well. I would encourage you to think of along those lines, which is, um, you can't be a master of all of them, but you can probably be a master of a couple and keep growing that over time. And I try to pick industries that I've had personal, professional experience in. I have professional experience in software, logistics, supply chain, manufacturing, mostly around software systems, implementing them in those particular industries. I have personal experience in cloud, public cloud. So those tend to be my strong suit. And I also have other experiences. I was a controller with a pharmaceutical company. It gave me a really good education on pharmaceutical because we had to operate a pharmaceutical production plant, as well as we took a drug from idea through the whole FDA process. And then we were allowed to sell it once that was approved. We did all kinds of stuff as a pharma company. So that really taught me the pharma business. And I worked for an oil company way back when. So that taught me the oil business, although energy isn't doing great this year. All right, so that's Instacart. I wanted to take a peek and see what was going on. Now let's get into 3 stocks that were put in the chat. We will hit AMD. I don't think I have AMD, or maybe I do. No, I don't have AMD ready to go on my evaluation. And my good friend Mike, hopefully he doesn't hold this against me. I always felt that AMD didn't produce enough cash. The fly in the ointment on AMD, excuse me. They grow their revenue. You can see the growth. That looks good. But when we get to free cash flow, they just have never been a consistent cash flow company. So my choices within semiconductor have been better than this in other places. Another company in semiconductor that I invested in for a while, made money, was Broadcom. And when we look at Broadcom's free cash flow, and Broadcom 15 years ago was smaller than AMD, but now they're much bigger from a market cap perspective. And if you look at free cash flow, just giant free cash flow. And look at the growth, right? Look at that beautiful growth. Cash growth. So Broadcom started like 30 years ago, and they started in California, not too far from where I live. And I have a 24-year-old son, and he went to elementary school with a classmate, and her dad was an early employee at Broadcom. So I got to know him because our kids grew up together, and he told me about the company and so forth. I started investing in this company years ago, and this is why: the cash. And they were tiny. 20 years ago, they were tiny, but now they're gigantic. They're the second biggest semiconductor company behind NVIDIA, true semiconductor company. So getting back to AMD. AMD has been around longer than Broadcom, much longer. And they can't produce free cash flow. Broadcom's way up there at like 20 billion in free cash flow per year. These guys are inking out $1 billion. What is wrong with that picture? Even when Intel was operating well, they had tremendous free cash flow. So that's always been my concern with AMD is, yeah, you grow that top line, but you can't grow your cash. And that's how I value companies. So that's why AMD has not been a desirable stock for me. And the market not necessarily trades off of intrinsic value, but AMD hasn't been able to hold their value for a long time. You see over the last 5 years, 67% rate of appreciation. But for certain times, it just really catches a lot of momentum and then it fades. Momentum fades. So it would be a stock that if you wanted to buy it and have kind of a swing trade plan where you expect it's going to rally for a while because they have good news, maybe they start selling their GPUs well, I could see an investor making some money that way. But it's not a long-term hold for me because they don't have cash flow. When you look at one of their competitors, their direct competitor being Broadcom does maintain its value. See how Broadcom has maintained most of its value. I think Broadcom's overpriced. I sold the stock. I believe in the business. It's a good business. It's just too expensive. Their valuation's way up there now. So you can see that, this is what I'm looking for. I'm looking for the line in gold here. That's why I bought Broadcom. Where AMD, I feel like it's a company on the cash flow foundation that I just showed you when I took through Instacart. There's not enough intrinsic value there for me to feel like I can own AMD for the next 5 years and that will more than double my money. I can't say that. But you can say it with other stocks that you see the strong free cash flow. So that's where I'm at with AMD. Let's take one more look at it. I wanted to see over the last month, it's down 6%. Year to date, it's down 22%. For the 1 year, it's down 41. So it may be luring investors who feel like, well, it's going to rally back. And maybe, I'm going to bring it up one more time. I'm sorry if you guys are tired of me bringing it up, but I really like ALAB. And there's a reason for it. This is an exciting company. These guys are a semiconductor company. They're tiny. They're like 300 some odd million. But when you study their fundamentals, like Broadcom was a tiny company at some point and they grew really nicely. But when we look at ALAB, this is a small semiconductor company. 2 years ago, they were 80 million in revenue. Now they're 400 million. Whoa. Look at this growth, 242%. Margins are there. Free cash flow is there. Free cash flow. They're doing 100 million in free cash flow off of a $400 million number. That's 25% of cash flow yield. That's really good because they're a fabless semiconductor company, meaning they control the intellectual property, the design, and then they go to a TSM or somebody to manufacture. And that way they don't have to deploy a bunch of capital and they can really be cash rich like Broadcom. And this one I'm excited about. So when we look at AMD or any company, I look at the choices I have. And in semiconductor, I have better choices than AMD. And I've historically have had better choices than AMD that I've taken and I've made money on. I've made money on TSM. I owned TSM for multiple years, tripled my money. Thank you, TSM. Broadcom made me money. Intel lost me money just to, keep the score right. And this one here just has never been a company that I've qualified into my process and became an investor on. So those are my comments on AMD. Hopefully they announce something positive and you make some money on that, Mike. All right, let's talk about TX. And TX is Ternium. I think they had a good day today. And so the material space is number one if you look at the sectors, right? Sectors is 11 sectors and all stocks fit into one of these sectors. Materials are companies that are gold miners. They produce gold, or miners of copper, iron ore, coal. they're mining it or they're working with it and producing it as a commodity to the market. That's the number one sector, 2025. And they had a good day today. Having said that, Ternium is in that sector. But the difference is between the sector's performance and Ternium is that these guys have been sold off. They've been sold off for about a year. They pay a nice dividend. They're profitable. Forward P is 4.6. I was just complaining about Instacart being too high at 25. This one's at 4.6. And now those are materials companies. They're not tech companies. Revenue's 5.32 billion. Market cap is 5.32 billion and revenue is 17.65 billion. So these are just, this sector, it doesn't get priced like technology or like Instacart is a consumer discretionary company, I believe. Yeah. So is Amazon and companies like that. And analysts believe it's highly discounted. I think I'm buying into TX and I see the growth, steady growth. It has slowed down. The main operations for this company, they're headquartered in Luxembourg, but most of the operations are in Latin America. Mexico being the biggest operation, Brazil, Argentina, and a couple of other places in Latin America. And the US. They have some operations in the US. And they produce steel. And they mine it, but then they do something with the mined materials. They produce rolled steel. Then that rolled steel goes into appliances, cars, all kinds of products like that. The big production is in Mexico. So they either provide that rolled steel into the manufacturing complex in Mexico, or they export it into the US and then it gets put into the manufacturing supply chain here in the US. So they have a good market. They are profitable, I believe. They have been profitable, but this year they are unprofitable. Free cash flow has been excellent over the past, but more recently, not as well. Now, this one here, I'm buying, expecting that they're going to revert to their average. They may be having a down year, but I think they're going to go back to somewhere near their average. So I believe I took a number of years and used the average in my free cash flow forecast. That way I could say, these guys are going to be around. We're going to need rolled steel, period, right? We're still going to need washing machines, appliances, and cars, and you name it. Rolled steel goes into so many things. We're just going to need it. We're going to need to produce those products that people need. So it's going to be a necessity. So I like that about it. So I think it's a heavily discounted stock. That looks good. As a value investor, following, many who have done that, Warren Buffett likes to look for discounted stocks. Howard Marks, he's more focused on the purchase price versus the company. And I can go on and show examples. Well, I'm like that too. I want to find a good business and I want a really good discount. So let's take a look at my valuation of TX. So when I get you these details, I think it's Brandon's the new subscriber. You'll be able to look this up on your own. And that's Textron. Got to look for the next one. Here's TX. All right, perfect. So I used an 8-year average, and I'm expecting at some point, TX is going to revert back to its average and maybe even exceed that average. And that average is going to be $1 billion. And if I just use $1 billion and not grow it, so that's conservative. And long-term growth would be 3%. We're going to have an intrinsic value of $10 billion. We add cash, take away debt to get to an equity value of $11.4 billion. And we have a discount of 53% on a stock that's been really sold off. And I'm using the average over 8 years, and I'm not growing it just to be conservative. So by that measure, I feel like over the next couple of years, this thing's going to work. In the meantime, they pay that high dividend. So that's not a bad risk reward situation. I think I'm putting my capital in there. I'm going to get an income out of that dividend. It's already been sold off so much. How much lower can it go? I'm not expecting it's going to be sold off anymore. I'm actually expecting the opposite. It's going to rally at some point. And the sector has been doing really well. Materials have been doing really well this year. Earnings per share create a nice intrinsic or value based on earnings per share. And it's at 38% discount. So together, when I blend the two, taking more weight in the free cash flow method, we're up at 49% discount. So a nice discount on a company that's a solid business. They run really well. It's a necessity material. So I like TX. I also like BHP that has more copper production. It's more copper production related. It's down in Asia, and they can produce their copper and sell it to China. And China uses a lot of copper. So they're in Australia. So they could manufacture it. They could extract it, mine it in Australia, get it ready as a commodity, and then ship it to China. So there's a couple of good choices. And then another one that I've been buying into is Dow. And Dow is more of a material company that's more like a chemical company, but it's also in the material space. So that is TX. I think TX, again, it can't be sold off, much further. I think it's a solid business, and it provides a really nice discount. So that is I think it was for Herdo. And Herdo, if you want to look it up, you have access to that directory, and you can get these notes as well. You'd be able to see this. So that was TX. All right, let's take a look at Pfizer. I like talking about Pfizer. So Pfizer is a pharmaceutical company, and it's a business that stepped up, created vaccines during COVID, and they really have benefited from it. I mean, you look at the money they made and the cash they produced, they did really well. So the stock really worked. Then after that, they just got sold off big time. From the top to the bottom, they've sold off 62%. Wow. It's a big sell-off. And what I want to show is if you go before COVID, it was a $32 stock. Now they're a bigger business, bigger revenue, bigger everything, but they're trading for a lower price. That doesn't make any sense. They got bigger, they make more things, they have better balance sheet, everything, and they got lower priced. So I wanted to point that out. So this is a discounted company, but how's the business doing? And I've been keeping up with Pfizer. They acquired a few businesses during the COVID years when they were making all that free cash. And now those businesses have pharmaceuticals that are in the commercial stage of that particular medicine. They're making money on it. They're making profits and free cash flow. And this is what I believe is going to make this stock work this year. Is if we look at the annual, right, we're beginning to see it grow. Good. Had a contraction year because they were just selling so many vaccines, right? That you saw a big contraction. Thanks, Herdo. You're awesome, man. Thank you. And but here we're having a small growth rate in 2024. But when we go a little deeper, go quarterly, the quarters are growing at 31 and then 22%. So as we keep lining up quarters that are growing at 20, 30%, 2025 is going to show up as a 20, 25% growth year on a very big business that produces profits and free cash flow. I believe that's going to catch the market's attention, and this stock I'm expecting is going to rally. It's going to announce earnings on the 29th. So that's 2 weeks away, 2 weeks from tomorrow. And I'm really looking forward to that. If they can come in with a nice growth quarter, 25% growth, man, it's just going to continue to do what I think it's going to do, which is become a grower again. And they're not growing a little bit, they're growing a lot. And why are they growing? Because they acquired these businesses with all the cash they made on the vaccines. And now those businesses are in the commercial stage of their drugs. They're new drugs, so they're going to be around for a long time. And they're going to be producing long-term growth. So I'm excited about the stock. This business historically, let me get out of the quarterly to the annual, right? And this is back to comparing the current business, 63 billion in revenue. The year before COVID, there were 41 billion, right? But they had a higher stock price. Now they're 50% larger and their stock price is lower. That doesn't make any sense. To me, it shows that this business is discounted. The market paid more for this business back in 2019. That's an opportunity to me. The market is not understanding Pfizer. And if I'm correct and the market catches up, it's going to rally the stock and I'm going to make money. And that's my game. I want to buy stocks that are priced below intrinsic value. I want to buy them when the market doesn't understand them. And then once the market catches up with where the business really is, I make money. And this one I think is going to work. We'll see. In 2 weeks and a day, we're going to get a little more information, and it might put one more piece of their strategy in play. And hopefully it doesn't surprise me to the negative side. Hopefully it just comes in line with what I expect, a good quarter, and we're off to the races. Maybe as soon as in a couple of weeks, this thing starts to rally. Maybe it takes a couple months, but really bullish on the stock for those reasons. Cash flow is good. Gross margin, 74%. Very good. And you see how it's grown. When we had the years where they were trying to create those vaccines and made those vaccines. They had to produce those vaccines at a lower margin rate, but their revenue expanded big time, right? Their revenue went from 41 to 81 to 101. Oh, man. So they really grew during those COVID years. EBITDA margin, 36%. Woohoo. Beautiful. So let me look at the valuation of Pfizer. And again, any member, you can look up Pfizer on the, let me show you where it is on the, when you go to the shared drive of the member shared drive, you're going to look at this file, the VHI stock analysis. When you open it, you're going to see this file, and then you can just start looking, right? You'd go Control F, and then you'd put in the ticker, and you got to Pfizer. And then you can look it up. I did this analysis on February 4th, and you're good to go. Got a 34% discount. The stock price is going to automatically update, FYI, because there's a Google Finance feature there. And then you could see, oh, okay. Well, Victor, I think it's discounted by 34% when I look at free cash flow. It's discounted 39% when we use earnings per share. Overall, 35% discount. And this is, I believe, very conservative. Once we get good data on the growth, I'm probably going to improve this, make it better, and it's going to be valued more. I just want to play it's kind of conservative for now until it starts to work, and then I'll change that. So I love talking about Pfizer because I feel like that's one that as it comes together, it's fun to watch it come together. I felt that way about Robinhood. A couple of years ago, I'm like, no, Robinhood's going to really dominate the young investor market. And the pieces started to come together, and it's been a huge winner for me, and I'm glad. And Coinbase, same thing. And other companies that were really discounted, sold off, and then you put the pieces together, and it's fun and gratifying to see it work. That's how I feel about Pfizer, and I've done my homework on it. We'll see. I could always be wrong, but most of the time I am right. And it's my goal to be right more of the time so I can make more money. All right. So we covered Pfizer, and I think I've covered the list. Thanks again, Herdo, for the super chat. And just so that you know, I appreciate it. But as a member, you don't have to do super chats, but I really appreciate it. Thank you. If you're a member, you could ask for a stock to be analyzed and you're good to go. But I appreciate it. Thank you. All right. So moving on, let's take a look at, I wanted to look at Allstate. So Allstate did really well for me last year in 2024. And this year it hasn't been doing poorly, because if you consider that, hey, it's up 1.41%. And this year, right, if any stock is even just breaking even, that's a winner, because it's been a tough year. So year to date, it's doing okay. Over the 1 year, it's done well. And especially buying it correctly, this stock really worked. But I'm beginning to feel like, well, maybe this one's kind of had its best days. It's going to announce April 30th. It's a $51 billion market cap. Revenue's $64 billion. And the business is done well. This is insurance, right? And insurance is very unelastic, I guess, is what economists would say, going back to my college days, meaning that people just don't cancel their insurance. If we have a recession and we have tough times ahead, people will not cancel their insurance. It's just unwise, because what happens if your house burns down? Oh no, I canceled my insurance. I'm in California, Southern California, and in the middle of the day today, we had an alert go off on our phones that an earthquake had hit, and one did, a 6.0 in San Diego County. I'm in Orange County, north of San Diego. So I didn't feel it. I think my mother-in-law felt it, but she lives near us, but I didn't. And but that's an example of, you never know what's going to happen, a fire, something. So insurance is something of a necessity that people aren't going to cancel. So I totally get that. The revenue growth has been good for the business. They had a tough year in 22. It was kind of an adjusting year. And then they figured things out and became profitable again and began to generate really good cash. Look at the cash flow in 2024, more than double 2023. So real nice cash flow. So I did well with Allstate. Let's see where we're pricing that stock. And I like to look at stocks at least twice a quarter. And in this case here, that's Alley. Click to the next one. Now we're in Allstate. All right. So Allstate's not heavily discounted, but it is discounted. And I'm taking a free cash flow rate that is closer to their average. I'm not taking that high level because that'd be too optimistic. So knowing that I'm being really conservative with Allstate, I think it's a keeper. I own a little bit of Allstate. How much do I own of Allstate? So $41,000 of Allstate. So I'm just going to hold that. It pays a nice dividend. It has a nice discount. It can go up some, and I'll keep reviewing it, especially after their earnings. I'll review it and see if it's still discounted or if I want to do anything with it. I'm also buying into Chubb. Chubb, I think, has a better discount and overall gives me a better risk reward ratio. I started to do that, and what's interesting is if I compare Allstate, and the three that I compare is Allstate, Progressive, and Chubb. Chubb has lagged the other two historically. If we look at the 1 year, Progressive wins that battle. Chubb's right there with Allstate. But let's look at year to date. Year to date, Progressive is winning that battle. Chubb is there. Now, when I look at Progressive, their fundamentals are just not as good. But I've been wrong on that one because they've been outperforming Chubb and Allstate. But I think that Chubb has better fundamentals than both of these other companies. And I think they are performing okay year to date. I mean, it's a winner for this year. And I expect that it's going to do well over time. When we look at the 5 year, Chubb is doing well. So is Progressive. All three are good, but Progressive kind of wins that battle as well. So insurance has been a good space, been a really good space for the last 2 years. They had a tough year in 2022, 2023. The rates were not high enough, and they just can't change their prices really quick. They have to work with each state in the U.S., with the commissioners, and then adjust their rates. And they have to give the public some notice and time to adjust. But now they're making a lot of money. So hopefully those times, from a stockholder's perspective, hopefully that profitability time lasts for a while. So that is Allstate. All right. So looks like we've got 27 people on the live stream. Thanks so much for everybody for joining. Thanks again, Brandon, for being a new member. Herdo, Mike, the dividend investor guy. Thanks for joining. All right. So just a reminder, if you want to become a member, you go to the homepage of the channel, you click this guy. And if you're a member, you can ask for a stock to be analyzed. I'll look at it, do a deep dive. If you don't want to be a member, but you want a stock analyzed, you can buy a super chat for $5 and I'll analyze your stock. And those are your choices. So again, tomorrow is going to be a huge day for earnings. We're going to look at Johnson & Johnson. I'll look at that. I'll look at Citigroup, and I'll also look at B of A. I already looked at B of A when we looked at JP Morgan on Friday. I think it was JP Morgan, Bank of New York, and Wells Fargo announced on Friday. So I did kind of a schedule, a table, and compared all the big banks. I'll come back to that table, and we'll compare Bank of America and Citigroup and see where they fit. When it comes to banks, I look at book value, and I don't look at cash flow. It's not the right way to value a bank, because with those guys are not producing things. They're not providing a service. They're lending out money. It's a different business altogether. It's all about net interest margin. It's about increasing the book value of your bank. So I'll go through that when we analyze Citigroup and Bank of America tomorrow. And we'll take a look at United Airlines. Maybe we'll look at Interactive Brokers and some other companies. So we'll have plenty to do tomorrow. All right. So if there's no other request out there, you guys have a good night. Remember, pace yourselves. We're in earnings season. It's going to get pretty busy, and hopefully the market keeps rallying this week, and we can make a little bit of money. Just some parting thoughts on, the market had a good day, but it's been a really rough 2 months. Not a bad time to build up a little bit of cash and be ready for another leg down. It's been rough, and it can get rough again. And I don't know that we're going to go straight up after this. It may take a while for the market to begin to have a sustained rally. If we have good earnings, most definitely that could be the catalyst to move us up. But the flips, or the opposite to that, if we have poor earnings, then we may have the beginnings of that additional downward move, maybe going down 10, 15%. So remember that that's an opportunity. When we have a sell-off in the market, it is kind of a shock to the system, so to speak. When, like on the NASDAQ, it goes down 24%. It is it's a lot to take on, right? But it means that stocks are discounted. It means that some stocks are going to be really, really nicely discounted. And as a long-term investor, I want to go find them. I want to buy them. I want to hold them. I want to make money on them. So I want to take advantage of it. So I've been trying to get some cash in my portfolio, get some cash balances up there by harvesting some gains on some stocks, just finding cash wherever I can so I can have that dry powder ready. So I would have that parting thought out there. Maybe you might want to do the same. All right, everybody. Thanks for tuning in. I appreciate it. Have a good night.